If you're 65 or older and you filed your taxes the same way you did last year, there's a decent chance you just left up to $6,000 sitting on the table, and nobody at the IRS is going to call you and tell you that. I want to walk you through exactly what changed, and heads up, this is general information based on current tax law, not personal advice for your specific return. Now let's get into rule number 1, because this one alone could be worth over $1,000 back in your pocket. Here's the scenario. You're 68. You've been retired a few years. You take Social Security, maybe a small pension. Maybe you pull a little from an IRA each year. Tax season rolls around. Your preparer plugs in the same numbers as always, and you sign where you're told to sign. That's it. That's how most retirees have filed for decades. And for most of those decades, that was fine, because the rules didn't change much year to year. But 2025 and 2026 are different. Congress passed a major tax law last summer that specifically targeted people 65 and older, and it created brand new deductions, brand new limits, and brand new income thresholds that did not exist before. Most retirees have no idea these changes apply to them because the letter that explains it doesn't show up in your mailbox. It shows up buried in IRS instructions that almost nobody reads for fun. The people who miss it don't get penalized directly. They just quietly pay more than they have to, year after year, and never know it, because the only person watching out for their return is themselves, or a preparer who's moving fast through a stack of 100 other clients during tax season. Think about your neighbor, or your sister, or the guy you play cards with every Thursday. Odds are decent that at least one of them is over 65, drawing Social Security, taking some kind of retirement withdrawal, and filing the exact same way they have for the last 10 years, without ever hearing that any of this changed. That's not their fault. Nobody sent a memo. The IRS publishes these updates in dense legal language on its own website, and unless you go looking for it, you'll never see it. Here's why this particular year matters more than most. A lot of these changes aren't permanent. The new senior deduction we're about to cover is scheduled to run only through the 2028 tax year, unless Congress extends it. That means the window to actually benefit from it is limited, and every year you file without claiming it correctly is a year of that limited window gone for good. This isn't a rule that will always be there waiting for you. It's a temporary opportunity sitting on top of a permanent set of older rules that most retirees have never fully understood either. So where does this actually come from? It's not a rumor, and it's not a loophole. It's written into federal law. Congress passed the legislation known as the One Big Beautiful Bill Act in July of 2025, and the IRS has since published the specific rules for how it applies to filers 65 and up, right on irs.gov under its own newsroom guidance. Separately, existing IRS rules around required withdrawals, charitable giving, Social Security taxation, and Medicare surcharges are all things that have been on the books for years, some of them for decades, but that most retirees still get wrong, simply because nobody explained them in plain English. I'm going to go through 8 of these, one at a time, with real numbers and real examples, so you know exactly where you stand before you file. Number 1. The new senior bonus deduction is real, and it's worth up to $6,000 per person. Starting with your 2025 tax return, the one you file this year, if you turn 65 by December 31st, 2025, you can claim an extra deduction of up to $6,000. If you're married and both you and your spouse are 65 or older, that's $12,000 combined. And here's a detail people miss. Only one spouse on a joint return needs to meet the age requirement for that spouse's $6,000 to apply. So even if your spouse is younger than 65, you still personally get your own $6,000 piece of it. Here's the part that surprises people. You don't have to itemize to get it. It doesn't matter if you take the standard deduction, the one almost every retiree uses. You still get this on top of it. Let's put real numbers on it. Say you're a single filer with $60,000 in retirement income between Social Security, a pension, and IRA withdrawals. That $6,000 deduction, on top of your regular standard deduction, could reduce your taxable income enough to save you well over $1,000, depending on your bracket. For a married couple both over 65, pulling that full $12,000 off the top of your combined income, in the 22% bracket, that's over $2,600 back in your pocket, just for being 65 and filing the right form. Most people stop here and think, great, automatic money. But don't stop here because there's a catch in rule number 2, And it's the single most common way people accidentally shrink this deduction without realizing it. Now here's where it gets important. This new $6,000 deduction phases out as your income rises. If you're single and your modified adjusted gross income is above $75,000, the deduction starts shrinking. For married couples filing jointly, that phase-out begins at a combined $150,000. It disappears completely once you hit $175,000 as a single filer or $250,000 joint. Here's the mistake people make. A retiree who does a large Roth conversion or sells an investment or takes a bigger IRA withdrawal than usual in a single year can accidentally push themselves over that threshold and lose part or all of this deduction without ever realizing that decision cost them real money. Picture a 70-year-old widow who normally lives on $55,000 a year. But this year she sold some stock to help her grandson with a down payment, adding $25,000 of capital gains. That single decision can push her modified adjusted gross income right into the phase-out range and shrink or wipe out a deduction she otherwise would have gotten in full. If you're anywhere near that $75,000 or $150,000 line, this is something to actually calculate before December 31st, not after. Because once the calendar year ends, the income is locked in, and there's nothing you can do to undo it. Number 3. This new deduction is separate from the additional standard deduction seniors have gotten for years, and a lot of people confuse the two. Under existing law that hasn't changed, if you're 65 or older, you already get an extra $2,000 added to your standard deduction if you're single, or $1,600 per spouse if you're married and filing jointly. That's not new. That's been around for a while, and most retirees already get it automatically through their tax software or preparer without thinking twice about it. What's new is that the $6,000 bonus deduction stacks on top of that older one. So a single 68-year-old could be looking at their regular standard deduction, which for 2025 runs around $15,000 for a single filer, plus an extra $2,000 for being over 65, plus up to $6,000 more from the new bonus. That's potentially over $23,000 in total deductions before a single dollar of income tax is calculated, all in the same return. Most retirees only know about one of these. Knowing both exist and knowing they work together instead of replacing each other is the difference between a good tax return and a great one. Here's the part they never tell you. Number 4 is about required withdrawals from your retirement accounts, and the timing rules are stricter than most people assume. If you have a traditional IRA or 401k, the IRS requires you to start taking money out once you hit a certain age. If you were born before 1960, that age is 73. If you were born in 1960 or later, it's 75. Miss that deadline or take out less than required, and the penalty is steep. It used to be 50% of the shortfall, back when this rule had real teeth. Current law dropped that to 25%, and if you catch and correct the mistake within 2 years, it can drop further to just 10%. But here's what most people don't realize. That 25% penalty is calculated on the amount you should have withdrawn but didn't, not on your whole account balance. So if your required withdrawal was $20,000 and you missed it entirely, that's a $5,000 penalty for one missed deadline, on top of the regular income tax you'll still owe once you do take the money out. And here's a detail that trips people up every year. The very first required withdrawal, the one for the year you turn 73, can technically be delayed until April 1st of the following year. But if you delay it, you end up taking 2 required withdrawals in that second year, both counted as income in the same 12 months, which can push you into a higher bracket or trigger the Medicare surcharge we're about to cover. Most financial professionals will tell you it's usually cleaner to just take that first withdrawal in the year you turn 73, not the following spring. Mark your required withdrawal date on your calendar now. Don't wait until December. Number 5, and this one genuinely surprises people every single time I bring it up. If you're charitably inclined and you're 70 and a half or older, you can send money directly from your IRA to a qualified charity, and it counts toward your required withdrawal without ever counting as taxable income to you. This is called a qualified charitable distribution. For 2026, you can send up to $111,000 this way, and married couples can each use their own limit from their own IRA, so a couple could potentially move over $200,000 combined in a single year. Here's why this matters so much. Say your required withdrawal this year is $15,000, and you already give some of that to your church or a charity every year anyway. If you take the $15,000 as regular income first and then donate it, you pay tax on the full amount. And unless you itemize, which most retirees don't anymore under the current standard deduction, you get no deduction for the gift at all. But if that same $15,000 goes directly from your IRA to the charity as a qualified charitable distribution, none of it counts as income. Your required withdrawal is satisfied, your charity still gets the money, and your tax bill is lower. There's a second benefit here too that most people never connect. Because a qualified charitable distribution never shows up in your adjusted gross income in the first place, it can help keep you under the income thresholds we're about to talk about, both for the senior deduction phase-out and for Medicare's surcharge. Most retirees who give to charity every year have simply never been told this option exists. It has to go directly from the IRA custodian to the charity. If a check comes to you first, even if you immediately hand it over to the charity yourself, it doesn't count. The transfer has to be custodian to charity, no exceptions. Now, number 6, and this is the one almost nobody talks about, even though it's older than every other rule on this list, and it quietly affects more retirees every single year. Up to 85% of your Social Security benefits can be taxed as income, and the income thresholds that decide whether that happens have not moved since 1984. Not once. Not for inflation, not for cost of living, not for anything. Back in 1984, Congress set the line at $25,000 for single filers and $32,000 for married couples. If your combined income, meaning your adjusted gross income, plus any non-taxable interest, plus half of your Social Security benefit, goes above those numbers, up to 50% of your benefit becomes taxable. Cross $34,000 single or $44,000 joint, and up to 85% of your benefit can be taxed. Here's why this matters so much today. In 1984, those thresholds were designed to catch only the wealthiest retirees, roughly the top 10%. But because the numbers were never adjusted for inflation, while literally everything else in the tax code was, a retiree today with a modest $30,000 Social Security benefit and a $35,000 IRA withdrawal, someone who would have felt solidly middle class in almost any era, now lands squarely in that 85% tax bracket that Congress originally built for the wealthy. Most retirees assume Social Security is simply tax-free, because for decades, for most people, it basically was. That's no longer a safe assumption. Let's walk through the math on one real example, because the worksheet the IRS uses for this is genuinely confusing on paper, but the concept is simple once you see it in action. Say you're single. You collect $30,000 a year in Social Security, and you also pull $20,000 from a traditional IRA. Half of your Social Security benefit is $15,000. Add that to your $20,000 of IRA income, and your combined income for this test comes out to $35,000. That's above both the $25,000 and the $34,000 thresholds for a single filer, which means you land in the top tier, and up to 85% of your $30,000 Social Security benefit, or roughly $25,500, becomes taxable income on top of your IRA withdrawal. A retiree in that position who assumed their Social Security was untouchable can end up with a much bigger tax bill than they expected, simply because nobody walked them through this formula ahead of time. The new $6,000 senior deduction we talked about earlier reduces your overall taxable income, but it does not change this underlying formula at all. The two rules operate completely separately, and a lot of retirees don't realize that getting the new deduction doesn't mean they're safe from this older one. The only real lever you have here is managing how much other income you bring in on top of Social Security in any given year, which is exactly why the qualified charitable distribution and required withdrawal timing we just covered matter so much. Every dollar of IRA withdrawal you can route around, whether through a QCD or careful timing, is a dollar that doesn't get added to this combined income test. Now for the one that costs retirees the most money without them ever seeing it coming, and it's tied directly to what we just covered. Number 7 is the Medicare surcharge most people have never heard of until the bill arrives. It's called IRMAA, the Income-Related Monthly Adjustment Amount, and here's how it catches people off guard. Medicare looks at your tax return from 2 years ago to decide what you pay for Part B and Part D this year. So your 2026 Medicare premium is based on your 2024 income. For 2026, if your income as a single filer was above $109,000 or above $218,000 as a married couple, you don't just pay a little more. You jump into an entirely new pricing tier, and the standard Part B premium of $202.90 a month can climb as high as $689.90 a month per person. That's not a typo, and that's not a one-time fee. That's every single month for the full year. Here's the part that really gets people. This is a cliff, not a slope. $1 over the threshold and you pay the full higher tier, not just tax on the dollar over. Picture a married couple who sold a piece of property in 2024 and reported $280,000 in income that year from the sale. 2 years later, in 2026, even though their actual day-to-day income has gone back to normal, each of them gets hit with an extra several $1,000s a year in Medicare premiums for a one-time sale that happened 2 years earlier and no longer reflects their real financial life at all. If your income dropped significantly since that look-back year, due to retirement, the death of a spouse, marriage, or another major life change recognized by Social Security, you can file Form SSA-44 to ask Social Security to use a more current income figure instead of the outdated one. Most people never file it simply because they don't know it exists, and Social Security is not going to volunteer that information to you. Qualifying life events that let you use Form SSA-44 include retirement or reduced work hours, the death of a spouse, marriage, divorce, or a loss of income-producing property. If none of those apply and your income was simply higher 2 years ago because of a one-time event like a large capital gain, that specific situation generally isn't covered by the form, which is exactly why the planning has to happen before the sale or the conversion, not after. Talk to whoever prepares your taxes before a big one-time transaction, not after, because by the time the Medicare letter arrives, the decision that caused it is already 2 years in the past, and there's nothing left to undo. And finally, number 8, a smaller one but worth knowing if you give to charity and don't itemize your deductions. Starting with your 2026 return, even if you take the standard deduction, you can now deduct up to $1,000 in cash donations to charity as a single filer, or $2,000 if you're married filing jointly. For years, non-itemizers who gave to charity got nothing extra for it on their federal return, no matter how generous they were. That changed. It's a smaller number than the other rules on this list, but if you already give to your church, a food bank, or a local nonprofit every year, this is money you weren't claiming before that you now can, and it costs you nothing extra to claim it. So here's your one action step for this week. Pull out your 2025 tax documents, or your most recent pay and income statements if you haven't filed yet, and calculate your modified adjusted gross income. Compare that number to the $75,000 single or $150,000 joint threshold for the new senior deduction. If you're under it, make sure whoever prepares your return files IRS Schedule 1A, because that's the specific form the $6,000 deduction gets claimed on, and it does not happen automatically just because you're over 65. If nobody files that form for you, you don't get the deduction, full stop. If you use tax software yourself, look for it by name, Senior Deduction or Schedule 1A, before you submit your return, not after. And if you had a major one-time income event in the last 2 years, a home sale, a large Roth conversion, an inherited IRA withdrawal, take 5 minutes this week to check whether it pushed you into an IRMAA surcharge tier. And if it did, look up Form SSA-44 on ssa.gov before your next Medicare premium is set. That's the full picture of what changed for retirees this year. And honestly, most of it isn't complicated once someone actually walks you through it in plain language, which is exactly what I try to do every week on this channel. If this helped clear things up, consider subscribing, because next week I'm breaking down exactly how the IRMAA 2-year look-back trap works in more detail, along with the specific steps to avoid getting pushed into a higher Medicare bracket by accident. I'll see you in the next one.